Hello and welcome to our session to cover important topic today, whether the market condition has changed and what it would hold for us in the near future to perhaps even intermediate future. But before we go on to examine that particular topic, just want to point out the disclaimer. As you will see, the things that I present and any discussions that we go over is purely for educational purposes. It is not meant to give you specific advice or to encourage you or not to encourage you to engage in any trading of financial instruments, and they do carry high risk, and also that I am not under any governmental jurisdictions authorized to give such advice. So whatever you do with this material, of course, is entirely your own responsibility. But hopefully the educational element of the material will be very useful to you and will enable you to continue growing in your analysis or ability to analyze market and apply them in real situation. What I hope to cover today is where the stock market is now in relation to where it will be going. A couple of months ago, I posted a chart on TradingView under the heading S&P 500 bearish outlook, and is close to forming a generational top. And I said generational top because I suspect that if this is a correct interpretation, then this top is going to be one that will be remembered for a long time, just like we are able to remember the major market top in 2000 and in 2007-2008. However, those were relatively short-lived, and the market then continued to retest those highs and make new higher highs. So in contrast to that, I think we have a very significantly different top being formed in the market today. So in order to reach correct conclusion on that, we will look at various indications which will help us to answer if we are there yet. We will also consider what well-known commentators and experts are saying regarding the current market situation, and examine what can help us to reach a correct conclusion on this for ourselves. So before we proceed on to that, I encourage you to go to my website, which currently is in process of development and is not fully functional, but there are a lot of features available there. You'll be able to access a lot of free material that is already there, and any material that I will post in the future which will be free. So feel free to go through www.danvi-charting.com, enter your email and register to sign up to receive access to free content, and also important communication that will be coming out shortly with regard to the subscription service that I will be launching this month, and formal commencement of that service will begin from 1st of November. So feel free to go there and check out what's available currently in the content, and continue to receive any future communications regarding all the updates that I will post under a free section and details of the subscription service that will be launched. You can also continue to follow me on YouTube channel under Dan Varasani, and there are a lot of videos already there regarding the market and different elements, all focusing on analyzing the live market and learning how to approach analyzing these with application of various multidisciplinary approach. that employs traditional stop support resistance, trendline channels, pitchforks, fibs, and Elliott waves, a combination of these. Similarly, you can also continue to follow me on TradingView, www.tradingview.com, under my name Dan V, and under my profile again you'll be able to see a lot of the material that I have published. One in particular we'll be coming back to in a moment is the one that is referring to the major generational top that is being formed, which I published approximately 2 months ago using S&P 500 chart. Let me just scroll down to that chart. So this is the chart we'll be looking at. S&P 500, it was posted approximately 2 months ago, as I say, under the heading S&P 500 bearish outlook, and it was close to forming generational top. Now I think that top is probably already established or being formed right now. So before we progress on to that, I just wanted to take a few minutes and update you on the gold option trade that we've been following for a little while. And this one is, let me just show you the chart here. This is the gold chart, and we commenced this particular trade where we have here this vertical line back end of May, when we were still in this minor triangle, and you can view the details of these in the YouTube channel and also on my website, where I explained the logic behind the trade that I entered, and then I provided a further update in September, and I'm going to provide this final update where we will be looking to close the trade out on any further weakness, retesting these major lows we had in gold. And the logic behind it is my understanding was that we are in this major larger triangle kind of a congestion, which I think is a wave B. Many think that this is the wave 4, but I think it's a wave B. But nevertheless, I was expecting at the outset for 5 wave decline, and from what has transpired so far, it looks like we have a relatively short wave 1, retracement wave 2, and it's a complex retracement wave 2. Then we had a 5 wave decline to give us a wave 3. We have subsequently bounced back into what I think is a wave 4, and so I am curtailing my bearish view on gold to the point where we will probably retest these lows, and in order to flush out any stops for anybody who is long, we will probably need price action taking those lows out. So we could quite easily still decline into about 1180 to 1150 area, but probably not much more. There are many who are talking about going almost to 1,000. I don't think that is likely to happen, but nevertheless, we will be expecting a further weakness in gold. So the original trade that we entered was a condor trade, and the trade that we entered was using this particular legs here, which are outlined on the chart. So in that particular trade, what we did is we sold the call at 1350, and to protect ourselves against that, we bought 1300 call, all December series, 1300 call. So if the market was to run up, then we would be protected. But if the market was to continue weakening, then that selling 1350 call would help us subsidize part of our cost. And then on the downside, which is what we were really expecting as a weakness, is what we did is we bought a put for 1250 and we sold a put for 1200. So that was right at the outset here. Then subsequently we allowed the trade to do what it needed to do, and in fact when we came to this particular line, which was 27th of June, 25th of June, what I then did was I made an adjustment whereby the market had or was looking like it had reached the upper limit of that congestion. So we were then going to expect a decline. We didn't get much follow through from this minor triangle, but then from a larger triangle we were at the top end. So what I did was, understanding where we were, what I did was I sold out the 1350, sorry, I sold out the 1300 call for a little bit of profit, and I left this call here, so I was exposed. So if the market was going to continue higher, I would have to reconsider my trade. But as it is, it only presented adverse excursion for a few days, and then we started declining strongly. So I left that one to run to its natural logical conclusion that eventually we would have that one expiring for practically nothing, or we'll buy it for very little back from what we sold. And the one that we would make the money was the 1250 put, and I also sold that one, bought it back rather. Originally I sold, so I bought it back. So I bought that one back and I sold the call, and in doing that I was able to receive a credit for $1.18. So my net cost then was dropped down from 380 to 262. So that would mean that I had spent $2.62 once I had made the adjustment on the remaining trade. The way that trade is today is a screenshot here, is this one, where you can see, for example, that the one that is at the top end, this one here, sell, which I sold 1350 call, I can practically buy that one now for just about $60 to $50. Or if the market declines, that would fall down to practically zero or very little, maybe $30, $40 to buy it back. So that one is near enough reached its maturity, but we would still leave it there for, if the price was to decline, then whatever it is costing today, 60 to 50, we would at least have to spend less than that in buying that back to cancel the trade. And then on the downside, recently when we had the price action where we dropped to this low here, 1190 area, that 630 was very close to 1100. But since we bounced back, we've lost partial, and there was no indication that I could close that trade right there and then, because I was expecting a much further decline to the downside. But now looking at it, I think we have now retracing wave 4. So as I say, I'm just looking for retesting of those lows and maybe making a new minor lower low, probably going up to 1150 as a round number, or maybe just about 1180 sort of area. So any further decline, I will probably get that 630 going back to close to 1000 or 1100, and I will be looking to close that trade out. So what we've accomplished so far is, on relatively modest risk, we are able to get about 30 to 40% return on our original capital, whereas now we have actually recovered everything that we used to buy or enter into the trade, and we have a profit of about $630. Well, and if you take out the purchase price of 60 to 50, then the net profit at the moment is $567. That is on the 5 contracts we've entered. So this was simply to illustrate what could happen. So we are looking possibly to come out, by the time we exit this trade, we would be closer to $1,000, and then that $1,000 will enable us, if required, either to add to our growing capital or to finance our trade that we have been really waiting for, which is once the gold bottoms, then we expect a significant bounce back from there. So we'll be looking to enter into that particular trade. And the way we would enter, let me show you just as an idea. The way we would enter is this particular trade that I have partially already compiled. So what I'm going to do is I'm going to show you briefly what that is, or how it is constructed, what we could expect from it. Okay, so what I need to do is to okay, so let me just go back. Okay, so what we've done here is very similar sort of strategy to the one that we used previously. Previously we had 4 legs, so it's called Condor. On this one I am suggesting a possible 3 legs. So within this 3 leg, what we have done is that we have, because the market is still declining and we are not buying this right now, we are looking to buy this as the market declines and drops to 1180 or a little bit lower. So hopefully we'll get more. At the moment they're suggesting that we can only get a credit for this one for about 60 cents to 87 cents. However, I'm looking to get a credit for at least $1 plus $1 or more. And in order to get that, what I'm suggesting, I'm going to take a series where I am buying a put option, or rather, let me put it this way, I am selling a put option for the series of 2016, so it's a very long option, very long-term option, and I'm getting some credit for that, and some of that credit I'm using in buying protection for 6 months. So if in the next 6 months, once I've entered into the trade up till June 2015, if my trade is not going in my favor, I will have to reconsider, maybe exit with a limited loss or probably break even. But ideally for 6 months, that June option will provide me protection against the 2016 put option at 110. If the market did drop to 110, I will be protected, plus the fact that I've got an option to sell at 111. So I will have a bit of profit on that, but nevertheless it's basically providing me protection. And my real trade is the one where I'm buying a call option for January 2016, so that's almost like over 12 months. So it will be like a 12-13 months option. And in that 12 to 13 month option, what I am hoping for is that once this gold bottoms, we will be rising very strongly, and quite possibly will be going back towards the 1500, which previously was a significant support. And so we could expect, at least in short term, when it gets there, possibly as potential resistance. So if that played out, then based on our trade that we are looking at here, is that if it gets to 1500, for example, 1500, so you can see on this little text box, if it gets to 1500, then the value of our trade options will be approximately, theoretically, close to $7. So if, for example, in entering that particular trade, I am going to get approximately $1 in credit, then in addition to that, I will be looking for approximately $7 plus on the return once the trade gets to around about 1500. If it went to any higher, then that would be plus point. If it really got high in next 15 months to maybe something like 1600, then it's quite possible that I would be looking to get about close to $10. So relatively small risk, and it's a trade that would last for a long while. But for the time being, as the market is declining, I'll be looking to see what's the maximum I can get for this trade. So ideally I want to get a dollar, and if possible maybe higher. That's the nature of the trade that I'm basically looking at this moment in time, as a potential idea. And then as we get closer to the 1180 to 1160, we will review and see whether we need to adjust this so that we can get in at a good price, but as I say, close to about $1 at least anyway. So that is the sort of trade we would be looking for when we are considering the subscription paid service and a lot more. Okay, so that's, I thought I should update you on that. For many of you who have been following, I will want to see how the trade has developed. So with that done, I will close this off to try and free up the resources on the PC here. Okay, so we will now go back to this particular chart here, which is the subject of our discussion today. I posted this two months ago, and I carried out a fair bit of analysis, and I will basically take you through some of the things that I have done in order for you to reach your own conclusion and see whether this has any implication on what you should do in days to come. Okay, so first of all, back in September 2012, and some of you who have seen my videos before and those who have interacted with me will see this particular chart and recall that it was produced on 16th of September 2012 when the Dow Jones was in the region of about 1500, just not quite even reached the high that we had back in 2007. And I was anticipating at that time, based on the price chart we had here, is that the top end would be around about 16 to 17,000, and it was penciled in for late or end of 2013 to early 2014. And then I have updated that as price continued to go higher, and we had some further price to analyze. I then had a time turning window to about July 2014. So we've passed the July 2014, and we are now wondering whether this is going to play out. And essentially, it is based on this that I posted this chart 2 months ago, and also as further confirmed by a few other things that I have subsequently gone on to analyze. So one of the key things that I went to analyze was the Nikkei index and the correlation between Nikkei index and the Western market. But as we consider a generational top and not just something where the market is only going to make a partial retracement and then continue ever higher, many well-known commentators are posting this kind of comments. So on marketwatch.com, Howard Gold, he's the columnist who writes many articles on there, some of them very good, and he reckoned that the recent decline we've had over the last few weeks is nothing more than just a panic attack, and it's not really a bear market. And he goes on to give a lot of statistics regarding each of the market drops we've had in the past, where market decline X amount, how many months, etc. but his main point he's making is that most of this big bear market came in connection with the recession. Now it's easier with the hindsight to say that they came with a recession. But the question I would ask is, when we were at those significant tops, even the one that we had in 2007 and similarly at 2000, did anybody suspect that we were heading into recession? In fact, I can tell you, and you will recall, that in 2000 there was really no evidence, either from common media or even market commentators, and perhaps even fundamentals. Everything looked so good. And even Fed Chairman Alan Greenspan went on to say, he made a comment in March concerning Nasdaq, and he went on to say that Nasdaq is not going to collapse anytime soon. And in fact, he was praising the efficiency through technological advances and how he feels this is reducing the cost base of all the services and goods that we are buying. So it was really positive. So I can't say that anybody anticipated that 2000 was going to be a significant top from where market collapsed to the tune of 50% for the major market on Dow Jones, for example, and Nasdaq went on to lose well over 70% of its capital value. Then similarly, in 2007, whilst there were warning signs, but did anybody expect in 2007 that we were going to have such a horrendous decline where we lost nearly 50% or over 50% of the market value of the Dow Jones? And then Alan Greenspan's successor, Ben Bernanke, made the comment in 2007, in fact, just as we were topping, that the property market that was rising so strongly, and many people were using equity extraction from property by remortgaging, refinancing, etc., and then using these for consumer goods and such like, and he felt that was all adding to the GDP. So in fact, he thought that was excellent. He thought it was really good, that the properties are increasing in value, and he even suggested at that time to reduce the cost of borrowing is to then start looking for adjustable variable rates rather than fixed rates, because the adjustable variable rates at that time were very cheap. So in the process, we were topping, but he didn't know, neither did I guess any commentator at that time warned people that as we were approaching that 2007 top, that the market looks very vulnerable. And it's only now with a hindsight we think it was in connection with the recession. So it's okay for Howard Gold to say that these were all in connection with the recession and we don't have a recession now, but I think this comment is out of context, and it could easily mislead people to the point where they would think, just like back in 2000 and 2007, there was no evident recession in the immediate horizon, and yet that's exactly what happened. So I'm not saying that this time around we are right there and facing that such a recession on similar magnitude. However, it should not be dismissed, because recessions in fact don't flash up before the market collapses or decline. As you all know, that the market often looks forward to possibly 6 months, 10 months in future as to how economic background is going to fare. So if the market begins to experience weakness, a severe weakness, then maybe that is suggesting that we don't have a recession right now, but it's quite possible that maybe in 6 months, maybe 10 months, we would face very significant and very noticeable and unmistakable recession. So take what he says with a pinch of salt, make your own conclusion, come to your own conclusion as to exactly what the market is doing now. The second article, also from the same website, is regarding this one here, where he thinks by using this particular chart from McClelland's market report, he feels that the price action that led up, I will not take my mouse there because apparently as I do that, it seems to be blocking it. So anyway, you can see he is suggesting there that in previous occasions when the market came up to the top in 2010, which was relatively short-lived, he has extracted the price and now applied it to the 2014, and he reckons that the decline we've got in 2014 now in September is actually going to be short-lived. It's only going to be like the bottom we had here. It's going to be short-lived, and he reckons then the market will continue higher. So based on his analysis, he is using a piece of price action from historical past and seemingly trying to apply on the current market, and suggest that the remainder of the outline is going to unfold, and therefore this decline is going to be relatively short. Well, if that was the case, then we don't have anything major to panic with. But supposing if it does not, supposing his comparison of the previous price action and what he is suggesting is likely to unfold based on the previous action fails to follow. Supposing we actually have a different structure, a different environment, a different time in the cycle. Previously, leading up to April 2010, we've only been rising probably just about a year. But supposing now we have been rising since the low in 2009 for well over 6 years, or very, very close to 6 years. So would that change anything? Well, you can answer that question, and you can see whether this is something where we would be looking for market to bottom out. And if we did, I would be more than happy for market to bottom out and continue higher. You can rest assured with that. But if it doesn't, then would this require an alertness on our part? And the final one that I'm going to highlight is someone I respect very highly. This is an individual, is Neil Woodford. He is a fund manager in UK, a fund manager with an excellent track record for the last 30 years, and there aren't many fund managers who have produced a record like his on investment return year on year, and you can do your own reading on him. Very, very successful fund manager, and in fact when he speaks, I think most of the industry, at least in UK, will listen. So I can't really say anything negative about him. However, even the caliber of such a brilliant professional is making comment like saying that the most severe sell-off he thinks is going to be relatively quick and probably almost done. In his comment here in the article, he goes on to say that he thinks it's going to be a few more weeks or a month, and then it will be all over. So again, if it's going to be all over and this is just a very temporary blip, then great, we have something positive to look forward to. But if it's not, then should this cause us concern and perhaps at least begin to form our own plan of action which could enable us to avoid the worst that is coming or that could follow. So let me close those tabs off now. Okay, so we will now go on to the chart that I was showing you here, which suggested that we were looking for Dow Jones topping between 16 and 17,000, and as I outlined initially, by end of 2013. Subsequently, I revised it to July 2014. So I continued to monitor this chart along with the other things, and previously in one of my other videos you have probably seen me comment on the Nikkei index chart, which I think is very, very significant and perhaps the most clearest in terms of confirming what could happen if our interpretation is correct. If it's incorrect, then of course it could be all completely different. But after having talked in 1990, we have declined in 5 waves to form this large wave A. Then we had this sideways correction, which I think is the wave B. So this capital B should have been here at the top of peak we had in 2000. And since then, I think we are carving out a very gentle falling wedge pattern where the end of the pattern is going to be narrower than the beginning of the pattern. And in that pattern we have already done wave 1, wave 2, wave 3, and just recently completed wave 4, and I think we are at a very, very early stage of now unfolding wave 5, which will at least retest the 2010-2009 low in Nikkei index, or maybe make a new lower low. And you can see, for example, based on that particular chart which was taken from Yahoo Finance side, then on my MT4 platform I went on to do the last falling wedge pattern with a clear levels where I think market was going to top out, and it was suggesting at that time that between upper end of 15,000, so close to 16,000 is where I was expecting at that time. And this particular chart you can see was made back in November 2013. So in November 2013, when we were still in this congestion triangle period here, I was expecting a potential top in the region of 16,000. And in fact, when we go into the live chart, you'll see that we actually did form a top, or are in the process of forming a top in that particular region. So coming on to that particular chart now, this one here is a Nikkei index chart. It's a live chart, end of day. So a monthly chart. So we see here, for example, that we came and made an ultimate high just around 16,600, and generally in the area, in the region where we expected, which was the declining trend line. So since then we have had a first leg down and then initial retracement back up, and you can see again this current month of October is very bearish. So if this unfolds, then I'm expecting Nikkei index to basically do like an ABC zigzag. Not clearly sure whether the wave A and wave C are going to be relatively equal or disproportionate. Like for example, in this one, we find that wave C was a little bit longer than wave A, and then over here we see that wave A was very long compared with wave C. So this is just an outline. I'm not suggesting that it will unfold exactly that. All I'm trying to suggest is that it will fall in a form of a zigzag ABC, and it will at least take out the 2009 low and maybe make a new lower low, possibly in the region of 6,000 area, for this falling wedge or the ending diagonal to complete. So if that was to develop, then in comparison, we have Dow Jones here, which has a very close correlation to Nikkei index. And when you do correlation analysis, it's not to establish how far each of these is going to move. There's two instruments, Nikkei index and Dow Jones. Each of them are going to move. You'll still have to take each instrument with their own respective price movement. But what it does tell you is that when significant highs and lows are formed in one instrument, likewise the other instrument performs the similar highs and lows soon after, if not at the same time. So just very quickly, you'll note that, for example, in 1996 we had Nikkei index already taking a turn, and the Dow Jones continued to make higher high. And then we had quite a period where Dow Jones just went sideways, Nikkei index continued to make a lower swing. Then the Dow Jones went on again, so basically now forming a secondary diversion, which is the lower high compared with this one, 1996, and then 2000 we had a lower high on Nikkei, and Dow Jones actually made higher high between 97 to 2000, and then they both declined together, and they both declined from then until the 2002 low formed in Dow Jones, and then Dow Jones formed a higher low and the Nikkei index made a lower low. Then they both went up together until we had this 2007 high in both indexes, and again we found that the Nikkei index was the first to start declining. Dow Jones made a marginal higher high before it also joined in the decline, and then subsequently Nikkei index have done A, B and C to the upside. Dow Jones essentially have done very similar and have reached the upper end of its limit, whereby we have a potential resistance line connecting the three tops together. Also based on the chart that I produced here, where we were looking for 17,000. So we are there, and now we have started to come down. And again on this occasion, you'll see that Nikkei index is the first one to decline. Dow Jones is just about now maybe commencing its decline. So if this correlation holds, then we have concluded that the Nikkei index have a potential to come down and retest 2009 low. So could the Dow Jones do the same, come back and retest its 2009 low, or at least if not, come and drop a significant level, probably back toward the 10,000 level as the bare minimum. I suspect it will probably do more than that, but at least it would come down to about 10,000. That would mean possibly losing 30% plus from the current value to 10,000. We are around about 15,000 now. So if we were to drop from 15,000 to 10,000, that would be like a third loss of capital value, which is significant, I think. Not something that people should dismiss it very lightly. So using this correlation analysis between Nikkei and Dow Jones, I think we are in a very vulnerable position for market to decline. So are we there yet? Well, I wouldn't come to a conclusion just using one correlation chart. Let me take you through a few other charts and looking at it from different perspectives, so we are not necessarily biased and come to a conclusion that we personally want to see unfold. So we are looking at objectively, looking at all the other ways of analyzing an instrument in order to come to this big conclusion. And the reason why we are analyzing all this, at least from my point of view, is we are not looking for anticipating a move over the next couple of months and move in a measure of 10% or so correction, which is what many people think it will be, no more than that. I'm not looking for that. The reason why I'm approaching this is because I am looking for analysis that could help me isolate where there is going to be a danger of a market to possibly lose more than 10% of its capital value. Because if that was the case, then personally I would suspect that I, along with many of the others, um, uh, in wider community, uh, would personally need to reconsider what they should be doing if at all possible. If it's not possible, then of course, you know, it's all academic. But if individuals are able to do something about it, then I think it can be uh, uh, very significant in terms of, action that we take could help us avoid a major catastrophical losses in any existing investment we might have, or pension funds, or anything like that. Because I can tell you, when we were forming a top in 2000 and we fell to 2002 low, we lost nearly 36% approximately in capital value. Um, in England, I encountered many clients of our firm that I was working for, whose investment we were helping, in inverted commas, to look after, where many of those clients were literally close to tears when we were analyzing what has happened to their investment. And equally as uncomfortable were the advisors in the firm, who were lost for any meaningful comments to explain what had happened, because most of those professionals who were working with me in that time, they've only had experience of investment going back from 1982, when the market really took off, and they never experienced this kind of a fall of 37. Even in 1987, when the market had a meltdown in a week, where it, I think, lost nearly 25% or something within a week, in that awesome market crash, it was relatively short-lived and market recovered. So there was nothing like nearly 2 years and over 2 years of market declining. In London FTSE 100 index, it went on for 36 months. 36 months. And in fact, this is what I've got here. Here, Dow Jones declined for 33 months. So, nearly 3 years. Many of these advisors never came across that kind of market decline, where year after year after year you've got nothing but really gloom and mental anguish of what to say to the clients. And as if that was not enough, maybe they were thrown a life jacket when market went on then to make a new high, but they had the same kind of problem again in 2007. So people say once bitten, twice shy. I say, well, in this occasion, within a space of 10 year, 15 year, we've had 2 occasions previously like that. Should you now ignore it? If it was to develop third time, and third time it could be more severe. It could be we are at a higher level to start off with, and if we went back and retested 2009 low, it would already be worse than the previous 2 declines. So I'll leave it at that. But let us go through and look at different ways of analyzing this market and objectively come to a conclusion. So the first chart I'm going to take you through now is the S&P 500. S&P 500. Let me start with this one here. So this is the chart, which is the consumer staples. And the consumer staples, as you know, is a group of companies who provide goods and services, which is classified as staple. So, come what may, whether we have recession or not, a lot of the staple food and basic necessities are something that will continue almost unabated. Uh, we might look for cheaper goods. We might look to buy more, discounted uh, goods, foods, and other services like that. We may even cut back on some of the very essential ones and stick to the most absolutely necessary ones if we feel we are on a very limited budget and we have to stretch that. But we can't avoid buying the very basic, day-to-day food and very basic energy and clothes and absolute bare necessities, something that we really do have to continue buying. And therefore the logic is that when the market is rising and people feel good about it and people feel richer or better off and economy is doing well, so they'll have a prospect for having good job, or at least a job that pays them enough in order for them to pay their way through, make some savings, and occasionally might be able to engage in discretionary spending. Discretionary spending is the things that they don't need to spend money on. However, because they feel good and more confident and well off, they may be able to exercise that discretion and spend money on things that are not absolutely necessary. So the logic behind this particular approach is that when the market is rising, you'd expect, like when the tide comes in, all market go up. However, when the discretionary spending begin to suffer, then we would expect the staples to outperform the discretionary. So what I'm trying to highlight in this one is this is simply looking at a discretionary, looking at the staple. And in the staple, it seems, as you can see from here, we had some kind of a sideway congested market effectively from 2000 up to here, and we started this one off, and I can best label this as possibly W, X and Y to form a wave A, retracement wave B, and now we have gone into making a clear 5-way move to the upside. And that 5-way move up, you can see, is, for example, a wave 1 up to here, which is the high in 2012, a small retracement as a wave 2, then we had a wave 3, wave 4 and wave 5. Or we may, for example, have a different labels applied on here, whereby we might finish up here, for example, this where it says wave A, that could actually become a wave A there, wave B here, and then these here just become W, X and Y, but the most important, it doesn't really matter as to which one, but the most important part is that we have had this rising wedge, and if you know anything about Elliott wave, rising wedge coming after a significant price progression really marks the end of the cycle. So once we break below what appears to be the short-term trend line here, that would be a confirmation that we have now completed the wedge. So until then, people can probably hang about and think, well, we're holding the support, and maybe even say, well, look, this is not a complete disaster. We have a potential support. What was resistance is now support, could become support, and market could take off. Well, it could, but the very fact that we have this as a rising wedge, and that rising wedge is very clearly labeled as 1, 2, 3, 4 and 5, meaning that doesn't matter how we label this area here, that end one is unmistakable. So whether it is A, B and C to this here, or whether it is W, X and Y with A, B and C, or whether we have this A back here, B back here, and then to say that this is wave 1, wave 2, wave 3, wave 4 and wave 5. It doesn't really matter, but significant part is this. And in contrast to that, look at the momentum and see how the 14 period RSI momentum on this weekly chart suggesting such a weakness that if this rising trend line support was to break, then this momentum would really plummet. And then this minor trend line rising, well, it's not minor, it's going up from here, from the low in 2009, but that trend line will probably not provide the support that it might have done back here in 2011, because once this movement begins, the momentum will be strong and any support that might materialize would be very temporary. So first of all, we are concluding that potentially based on this rising wedge as an ending diagonal is that the consumer staple is vulnerable. So if the consumer staples is vulnerable, what would you expect for the rest of the market? So any companies represented in this consumer staple sector, even those companies, price action of those companies will be the share price, I mean, will be forming something very similar and looking equally as vulnerable. Remember, this is an index of the consumer staple sector. So it's quite possible some of those companies will probably have already broken down and some may be in a final stage of completing that rising wedge. So one conclusion we can reach from this is consumer stable itself, which is supposed to be a stable sector, it looks to me as vulnerable, and maybe you would conclude similarly. And if nothing else, it tells us that we need to be alert, and is providing us that warning. We need to be alert to any further weakness as an indication that this market is headed much lower. Second one I'm going to take you is this one here, which is the let me just check to see if I've got a consumer staple, and no, I haven't got it. But let me check. It's a consumer staple because I was going to show a ratio of consumer staples and discretionary. So it's XLP. No, I don't think of. I think I have done it. I'm not sure where it is. But rather than waste my time, maybe I can highlight that one on another session. So consumer staple is vulnerable. This one here is S&P 500 or SPX index at the top, and then at the bottom is a ratio of SPX divided by the commodity. And when you're analyzing this, it struck me that in 2000 everything went down. Commodity prices as well as equity prices came down. Then we had equity prices rising, but the commodity prices, just like the consumer staples, actually just went sideways. So commodities also went sideways. They continued sideways. That is a ratio, by the way, and the reason why that happened was the equity index was falling, relatively speaking, or just went sideways, and the commodity prices were rising. So when we had a commodity prices rising from, many of them bottomed in 2000 and they continued rising all the way to about 2011, like gold and silver, for example, and then oil topped out in 2007, etc. So what it formed is this sort of a sideways congested period, and then we know that when the equity has been rising, the commodities in general have been falling. And in doing the ratio, I am struck by the fact that we have such a clean, that's the ratio of S&P 500 or SPX divided by the commodity, because when you look at SPX index itself, we don't have such a clear wave labeling, right? So you go 1, 2, 3, 4 and 5, very clear labels. Then you look at the momentum between the wave 3 and the top of wave 4, and is very clear in the divergence. And if you look at the rising trend line on the RSI on this last leg up, you can clearly conclude that is that's breached long time back. And on the price, we have maybe similar confirmation, like so, that the last week's action has actually now formed a clear break of that minor trend for the last leg. So for this ratio, it appears now that the S&P 500 divided by the commodity, we have a clear 5 waves, and when you compare that with the actual index, we have a breach on the actual index, just like the ratio chart we just looked at. And the last piece of that is actually nothing more than rising wedge. I'm sure you can agree with that. Rising wedge. So that rising wedge, just like the consumer staples, is reflecting the fact that the entire market is now in that final ending pattern, if it's not already ended. So if it's ended there, where could it go? Well, in a normal technical analysis form, you might say, well, look, on the index we had this year 1,500 on SPX, where potentially we could come and find a support. Well, if that was to happen, then it's still a long way to go to drop to 1,500. However, when it drops to 1,500, is it likely to be a lasting support, or is it one where it's going to be just temporary support? Effectively, if it breaks down to 1,500, one could say that this rising trend channel we had, which currently marks out the bullish trend, will be over. So if that is going to be over, then perhaps we could get a lot more decline to follow, or perhaps very choppy long sideways movement. We will now look at SP 500 with the VIX index, and you can see where my horizontal lines are. These are highs and lows of where the previous peaks and troughs were on the VIX index, and similar highs and lows being corresponding highs and lows being marked out on SPX. So when we were in this 1987 that I briefly mentioned, where we had a major collapse, it lasted a relatively short time, we had this VIX index, for example, rise to about 60. Then the VIX index in general continued to decline until we had 1994. Then again it tended to go up, but still remain well below the previous high, which was in fact in 1987 the high reached 167. We've never really reached that high because that one was such a sharp, but then it sort of recovered and the volatility index dropped off. So coming back to the volatility index, then here is we had a peak when the market made a bottom in 2009, and then again a higher peak around about 100 when the market made a low in 2009. And then subsequently you can see the VIX index has tended to continue down. And I think if you look at, for example, the RSI, is you can see now that we've got actually a diversion on the momentum indicator, and it looks like the short-term resistance line has been breached. And then we have this 50 is approximately an area where previously the range of support, range of resistance, range of support, and now it could or should be potential resistance. But if it now clearly breaks out, then we are suggesting that maybe we've got a lot more follow through in weakness to come. So recently the VIX index itself has broken out, and the SPX index has breached its minor trend line that has been supported from the low in August 2011. So the question mark is, if this one now drops, where is it going to go to? The next chart I'm going to take you on now is one where we have another matrix of the equity market, and this is the number of stocks above 200. And you can see on a longer term is that whenever we make a low, which in this case there are a few different levels, but the severe one we had was around about 10. That means only about 10, 11 stocks above 200 period moving average of their respective price. Then we have another one here is about 28 or 30 level, 30 stocks below their respective 200 period moving average. And then this one is the one where we've had perhaps quite a few tests. It's approximately 40 period. Okay, not 40 period, but 40 stocks below the 200 period moving average. So what this is telling us is that while the market has been rising, number of stocks above the 200 period moving average actually peaked around May 2013, and ever since we have had a phases where it was declining, and then in this last leg it actually went up. However, it couldn't breach the previous high where nearly 90 plus stocks were above their respective 200 period moving average. So this high that corresponds to this market high in July, we had just below 90 stocks above 200 period moving average. And then where the actual highs formed, we've had a clear divergence. So we've had a divergence on a longer term time frame, both from back in 2011 to now. Then the second diversion from May 2013, and then more recently between the last two peaks here. In the last two peaks, the index made higher high, but the weakness, the number of stocks participating in that move higher was dropping, and they have now dropped to the point where at the moment is only about 40 stocks, or maybe less, about 35 stocks above 200 period moving average. So the question now is it going to be one of these short one, which is what the commentators are thinking, that it's only going to be 10% move, or is it going to be more? Well, if you look at the chart itself, and on the chart itself, which is the index, I've got the brown is the 200 period moving average, the blue is 50 period moving average, and the red is 20 period moving average on daily chart. So looking at that, here we had relatively short period of 200 period moving average breach. This time likewise we have penetrated that quite a bit, but it's a question of whether it will recover and continue higher, or whether this is now the initial breach which will be retested, and then the market will simply just tail off. So it would depend now on what the price does as it reacts to this area here, in this area here. So will the market, for example, go back up and find that now considers this area as a resistance and then fail off. So we need to watch that, and over the next few weeks, maybe month or two, and see what the market does in that area. Because if it only does 10%, then there's no real problem. So in which case, this is about 2000 here. And incidentally, when you look at the charts that I posted here, I was expecting around about 2000 to 2037 or 2040, and in the comments I said around about 2030 was possible an area where we could be expecting this particular, around about 2030 was an area where we could be expecting this major top. So looking at this, then if we only drop 10%, then the 10% of 2000 is 200. So we should really only come down to 1800. So that would be approximate end of our current correction, around about here, 1800 area. If however we drop below that, then I think most people will then not argue that we have now made a top and the market will actually gather momentum in a serious way. But even in this area, if the market does not find a momentum to re-challenge this previous high, then I think you and I can conclude that the market has made an initial leg down and has now tried to retrace and done a typical retracement, which will be like a 50% or 61.8% retracement of this first decline, and the market would then taper off. So based on what happens in there, you can come to your own conclusion whether this market is simply going to make only 10% correction, or if this market is in severe trouble. And then going into the actual wave count, after having considered that we've got this rising wedge which is now complete, and so far on this daily chart, it appears to me that we had this first decline on SPX, partial retracement, and this significant decline here is, I think, possibly wave 3. So we've got minor wave 1, minor wave 2, then we've got wave 3, and apparently we have had a sharp a bounce in the last couple of days. So that could be wave 4, in which case we see another decline, at least to retest the low we formed here at 1820 area somewhere, or maybe 1800, and that should really be the end. So either to retest that or make a new lower low, that would complete the first 5 wave decline. So once we have that 5 wave decline, this is what I expect. Either we have that as possible larger degree wave 1 or A. 1 or A. If it is 1, and then of course this one could be wave 2 or B. So if it is 1, then we go back ABC retracement, possibly back to 1900 area, and then make a second leg lower. If it is just ABC, then this would be A, this could be retracement B, and we would then only go maybe as far as, well, if you do an equal leg, then possibly this will fall to maybe like 1600 somewhere. If however it's not an equal leg, then what we will have is potentially wave 1, retracement wave 2, and then we will be expecting wave 3, and the wave 3 is supposed to be strong and very dynamic, and in which case we will basically blow through any potential supports that we think along the way, and the market could be in severe decline. So what we need to do is we need to see this first decline 5 wave complete. So coming over the next few days, I think we probably had a wave 4 retracement. So during the coming week, I expect that maybe limited progress to the upside, and we should expect another decline back towards 1800 or a little bit lower, possibly 1700, maybe 1750. If you did a basic fib retracement of this last leg, then the 200% retracement of that comes in this area, which is 1780. So around about 1800, call it, we expect support, retracement back up, and it's really what happens in that area will tell us whether this market has actually made a bottom and is going to continue, or is this going to be just a retracement and then next leg lower, and the next leg lower will then make an absolute confirmation whether it is simply ABC with then market moving up significantly higher, or it's now in a proper bear market mode. So those are my reasons for coming to the conclusion that we have typical evidence that the market is making a major high, and the major high is already in place, and if I'm correct, we are unlikely to retest that anytime soon, and we would, for many months at least, we would probably decline quite substantially. But if this is a full bear market mode, then we could be looking at a decline that would last for probably a couple of years or maybe longer. In fact, my other charts suggest to me that if this is a generational top, then this would be a cycle on Dow Jones. We can go back right up till 1929, and I think it's a cycle that's completed from 1929 to now. So in that case, this market has risen for nearly 85 years, 84 years, in which case you can see if that was to decline or correct in some way, it's certainly not going to be over in a couple of years. It would last a lot longer. So that's the magnitude I'm talking about. And hence my urgency and the feeling of significant top being put, which could have devastating effect on your future wealth. So I will end it here. Again, this recording will be available for you to view on my site as well as on YouTube, and I encourage you to go back to the site and sign up if you haven't already done so. And likewise, when you view this video, when it's available on YouTube channel, if you like the content, if you like my approach, and if you feel that there is some real value to this, then I encourage you to share the video with a wider community, with those that you know and those you are acquaintance with, and also give your thumbs up to indicate that you like the content, which would then enable many others also to take interest in that particular video. And for those who wish to see what sort of things you can do both to protect your long-term wealth and possibly grow it, then consider joining when you receive the invitation. Consider joining my subscription service, where, as I said, I won't be giving you specific advice. However, the skill that you learn and maybe use to enhance your own existing skill and knowledge you have of market analysis could enable you to take full advantage of what's coming, and hopefully find it very practical. And if you have any specific comments, then feel free to interact with me by sending an email to info at www.danv, well, basically at my site. So it's info at danv-charting.com, and it will give me an opportunity to learn how you feel about the content, and whether there are any specific questions that you may have which you might want me to address in the future, in future sessions, and likewise ensure that my future deliveries are correctly composed and addresses the issues that you are interested in. So thank you for your time, thank you for viewing this video, and I sincerely hope that it helps you and is of practical value and benefit to you. Until next time, I wish you all well. Thank you.